I'm going to start with a fact that sounds impossible until you understand how fragile this machine really is. At 3:41 a.m., three different commodity desks in three different time zones stopped quoting prices at the exact same minute. No announcement, no outage notice. Just a sudden, shared hesitation. The kind that only happens when people realize the numbers on their screens no longer correspond to the contracts they're supposed to honor. That was the moment the Greenland Tariff stopped being a policy headline and became an emergency broadcast. You didn't feel it yet. That's by design. You felt the echo later when spreads blew out and volatility spiked for no obvious reason. But inside the system, the damage happened first, in silence, the way real failures always do. Here's the detail that matters. The tariff wasn't about Greenland, it was about classification. A quiet redefinition buried in a customs annex that relabeled certain refined inputs as strategic intermediates. That phrase doesn't mean anything to voters. It means everything to clearinghouses. Because once something becomes strategic, it stops being treated as a commodity and starts being treated as a controlled asset. Controlled assets don't clear the same way. They don't net the same way. And most importantly, shorts don't roll the same way. I saw the memo, it was not dramatic. No flags, no bold text. Just a paragraph on page 17 of a technical update circulated to compliance teams under the subject line, Harmonization Adjustment, Arctic Corridor. That's how they do it. If you make it boring enough, only the people who are paid to worry will read it. By 4:10 a.m., the phone started lighting up. Not ringing, lighting up. Messages from risk desks asking the same question in different words. Does this apply to inventory already in transit? Does this apply to contracts written under the old classification? Does this trigger remargining at the clearing level? No one answered immediately, because everyone already knew the answer and didn't want to be the first to say it. Yes, it applies retroactively. That's when the short squeeze began, long before prices moved. To understand why, you have to understand how global shorts actually survive. They don't survive by being right. They survive by being rolled, by being continuously deferred into the future under the assumption that liquidity will always be there to close them gently. A short position is only dangerous when it can't be rolled, and rolling requires fungibility. Identical inputs, identical classifications, identical settlement rules. The Greenland Tariff shattered that assumption. Suddenly, a category of material that had been freely interchangeable was split in two. Legacy inventory on one side, newly classified strategic input on the other. Same atoms, different legal reality. And the moment that happens, the math changes violently. I was watching a metals desk when the realization hit. You could feel it in the room. Chairs stopped moving. Someone wiped their hands on their pants without realizing they were sweating. A junior trader asked a question that no one answered. The screens kept updating, but no one trusted them anymore. Because the squeeze wasn't happening on price. It was happening on deliverability. Shorts require confidence that delivery can be sourced, not cheaply, just sourced. The tariff didn't raise prices immediately. It restricted flow. It introduced paperwork delays, inspections, approvals, time. And in leveraged markets, time is lethal. Within an hour, clearing members began adjusting margin requirements out of an abundance of caution. That phrase should terrify you. It's the bureaucratic equivalent of a doctor saying, "We're just going to intubate you to be safe." Margins rose not because prices moved, but because uncertainty did. Shorts that were perfectly hedged yesterday suddenly required more collateral today. This is where the feedback loop locks in. Higher margins force partial cover. Partial cover pushes prices just enough to trigger algorithmic risk flags. Those flags force more margin calls. More margin calls force more covering. And all of it happens before the public chart shows anything unusual. That's why you saw what looked like a random vertical move hours later. It wasn't random. It was the last stage of a process that began in a legal footnote. Now let's talk about who was trapped, not retail. Retail doesn't short at scale. This was institutional. Sovereign adjacent funds. Commodity merchants who thought they understood logistics. Banks that had built beautiful, efficient short books assuming that policy moves would be slow. signaled, and reversible. They were wrong. The logic of the system is simple and brutal. When a short becomes politically exposed, it becomes unfinanceable. No one wants to be the lender of last resort to a position that might be declared undesirable overnight. Liquidity evaporates not because it doesn't exist, but because it refuses to touch the problem. I watched a liquidity provider step away in real time, not exit the trade, just widen spreads until they were meaningless. That's how professionals say no without saying no. And this is why the squeeze went global. Once one market reclassifies a key input, every connected market has to reassess its exposure. Futures in one region, options in another. Structured products layered on top of both. The same short replicated across the world under the assumption of sameness suddenly becomes a dozen different risks that can't be netted. That's when you get the emergency broadcast tone without the broadcast. Why didn't the crowd see it coming? Because the crowd watches speeches and charts. They don't read annexes. They don't understand that tariffs are not about revenue. They are about leverage. A tariff doesn't have to be big to be lethal. It just has to be targeted at the wrong choke point. And Greenland was a perfect decoy. Remote, boring, easy to mock. While everyone argued about symbolism, the system adjusted collateral tables. This is financial warfare in its cleanest form. No sanctions, no seizures. Just a redefinition that turns yesterday's hedge into today's liability. Banks are not villains here. They are animals responding to a threat. When survival is at stake, ethics is replaced by geometry. The real damage isn't the price spike. The real damage is the precedent. The knowledge, now embedded deep in risk models, that policy can detonate shorts without warning. That realization changes behavior permanently. After that night, no one trusts carry the same way. No one trusts smooth rollovers. No one trusts that a position can always be exited in an orderly fashion. And when trust disappears, leverage follows. This is how systems seize up. Not with crashes, but with caution. You will hear commentators call this a one-off. They always do. They need it to be. Because admitting that legal reclassification can force global squeezes means admitting that markets are no longer sovereign. That politics sits upstream of price discovery. And that's a truth the system can't digest publicly. But internally, it's already digested. I saw the updated risk memo that afternoon. New stress scenario added. Abrupt policy-induced classification shock. That phrase didn't exist last week. Now it does. And once it's in the model, it will be used. Again and again. The Greenland Tariff wasn't about Greenland. It was a test, a probe, a way to see how fast pressure propagates through the system when you squeeze at the right point. The answer came back quickly, very fast. By the time the public realized there was a short squeeze, the most dangerous part was already over. Positions had been forced closed, losses crystallized, balance sheets adjusted. What you saw was the aftermath, not the event. And that's the pattern you need to understand. The market doesn't break where you're looking. It breaks where you're bored. I'm stopping here, because the next part isn't about how this happened. It's about what happens now that everyone inside the system knows it can happen again. Without warning, without apology, and without reversal. And that changes everything. And here the road splits into 3 paths, and all of them lead into pressure. Not chaos first, pressure. The kind that doesn't explode, but tightens. The kind that makes people choose badly because waiting becomes expensive. The system will call these paths outcomes. They are not outcomes, they are responses. Reflexes of a machine that has learned one thing very well: how to survive by transferring pain outward. The first path is the one everyone inside hopes for, because it lets them pretend they are still in control. The squeeze fades into the background. Prices settle into a higher range and are declared normalized. Volatility drops just enough to bring traders back. Commentators explain that the market digested the shock. New equilibrium, new baseline. Everyone nods. Balance sheets stop bleeding. Bonuses are recalculated. Relief moves through the system like a sedative. But look closer. In this version, nothing is healed. The structure is weaker than before. The cost of carry is higher. The margin tables never go back to where they were. They don't announce that part. Clearing houses rarely reverse caution. Once a risk exists on paper, it becomes permanent. Shorts return, but smaller, more expensive, less confident. Liquidity returns, but selectively. The system continues, but it breathes shallow. This is the optimistic path, and it works only if policy shocks remain rare and isolated. Only if that tariff was a one-off. Only if no one else tries the same move. And inside the system, no one believes that. Not anymore. So the road bends, and the second path reveals itself. The one that feels familiar if you've been around long enough. Markets don't collapse, but they change character. Everything becomes jumpier. Gaps appear where there used to be continuity. Positions that were once considered boring require active management. Risk committees meet more often. Legal departments grow louder. Traders stop asking, "Is this cheap?" and start asking, "Is this safe to hold overnight?" In this version, the short squeeze becomes a reference point. Not an anomaly, but a precedent. Every trade is now shadowed by a new question. What if this asset is reclassified next? What if a policy memo lands at the wrong hour? What if delivery terms change mid-contract? These questions don't show up in price models. They show up in behavior. You see it in how positions are sized. You see it in how inventory is hoarded. You see it in how elites quietly move capital toward things that cannot be redefined by a paragraph on page 17. The market still functions, but trust erodes. And when trust erodes, leverage follows. Then there is the third path, the one no one wants to name because naming it makes it real. This is where the squeeze does not fade, it cascades. Another classification, another tariff, another temporary measure. Each one small, each one defensible. Together, they turn rolling shorts into a minefield. One wrong step, one weekend headline, and a position that made sense on Friday becomes unfinanceable on Monday. In this version, the next squeeze doesn't wait months, it waits weeks or days. Liquidity pulls back preemptively. Spreads widen across unrelated markets because risk managers stop pretending they can isolate shocks. Funding tightens, correlations spike. The system doesn't crash in a single moment. It locks up in sections, like ice forming in pipes. This is where you get the real panic, but not the kind people expect. No screaming on trading floors, no dramatic halts. Just phones that don't get answered, requests that take longer, approvals that require one more signature. Panic in modern markets looks like delay. Now listen carefully, because this is where most people lose the plot. Do not watch the headlines. Headlines are written after the damage is contained. Do not stare at price charts waiting for confirmation. Price is the last thing to move when the problem is legal and logistical. If you want to know which path you're on, watch the signals that never make the front page. Watch bond yields, especially when equities rally. When stocks surge and long-term yields refuse to fall, that's not confidence. That's capital that doesn't trust the rally enough to seek safety. It's trapped, not convinced. Watch funding markets. When institutions choose official facilities over private ones, they're not optimizing. They're hiding. Watch inventory behavior. Not the headline numbers, but the cadence. When updates slow down. When categories are merged. When language shifts from available to subject to review. That's not accounting. That's rationing warming up. Watch elite behavior. Not what they say on panels. Watch what they quietly stop doing. When certain trades disappear. When certain products are no longer offered. When risk is avoided without explanation. Silence is not neutrality. Silence is positioning. And above all, watch delivery. Delivery is where lies go to die. When fulfillment becomes complicated, discouraged, or delayed without being denied, you are no longer in a free market. You are in a managed one. So what do you do when you understand that the system can force a global short squeeze with a footnote? You do not chase volatility. Volatility is how the system flushes weak hands and tests obedience. You do not anchor to narratives about overreaction or mean reversion. Those stories are written for people who need reassurance. You simplify, Physical assets that settle without permission matter in this phase, not because they will make you rich, but because they let you step outside the feedback loop. Physical gold, physical silver, not paper proxies that can be reclassified, paused, or substituted. The point is not upside, the point is refusal. The refusal to be forced into a settlement you did not agree to. Cash matters too, but only as a tool, not a destination. Cash is time. Time to wait, time to observe, time to say no, but cash only works if you can move it. Cash trapped behind gates, limits, or temporary measures is not time. It's another form of leverage against you. Reduce dependencies. Every intermediary is a potential choke point. Every layer adds a rule you didn't write. If you cannot explain how an asset settles under stress, you don't own it. You are renting it from a system that just demonstrated how quickly it can change the terms. And resist urgency with discipline. Urgency is the system's favorite weapon. It compresses your decision-making window until consent becomes automatic. You will be told you must act now, that prices are running, that access is closing. Sometimes this will be true. Often it will be bait. The skill is knowing the difference. This brings us to the part that makes people uncomfortable, because it removes the last illusion of safety. There is no authority that will step in to protect fairness when policy becomes a trading instrument. There is no referee above the game. There is only continuity. And continuity is achieved by sacrificing those who cannot adapt quickly enough. This is not a moral judgment, it's an engineering one, which means the only real hedge left is personal. The right to say no. No to forced rollovers. No to revised terms disguised as favors. No to substitutions offered when fulfillment becomes inconvenient. No to urgency that benefits everyone except you. Saying no does not mean exiting society. It means retaining agency when the system expects compliance. It means choosing slowness when speed is weaponized. It means holding things that don't ask permission to exist. Responsibility is heavy because it strips you of excuses. Once you see how a short squeeze can be triggered by policy rather than price, you can't unsee it. You can't pretend the market is neutral. You can't blame outcomes on randomness. You are responsible for where you stand. The people who survive this phase intact will not look heroic. They will look boring, conservative, overprepared. They will have given up some upside to preserve autonomy. They will have chosen resilience over optimization. The Greenland Tariff was not about geography. It was about proof. Proof that the system can still force outcomes without touching prices first. Proof that classification is power. Proof that leverage dies the moment politics enters the clearing equation. That proof is now embedded in every risk model that matters, which means this will happen again. Not in the same place, not with the same asset, but with the same logic, quietly, suddenly, and with the same effect on anyone who believes markets only move when charts say so. You are still early enough to choose how you stand, not what you trade, how you stand. Because when the next emergency broadcast comes, and it will, the only people who keep their freedom are the ones who already learned how to say no before saying no became expensive.